Thank you very much. What we thought would be interesting here today to discuss an issue which has gotten a lot of attention on the political campaign and among economists about the consensus, maybe not universal but widespread, that the U.S. economy be well served by an increase in public investment. This is something that Donald Trump talks about, Bernie Sanders talked about it. The Bipartisan Policy Center's Infrastructure Council ranges from Eric Cantor and Haley Barbour on the Republican side to Henry Cisneros and Antonio Villarosa on the Democratic side. But it seems to me there's a lot more talk than action, a lot of lobbying, a lot of reports, a lot of excitement about P3s, talk about infrastructure banks, tax credits. And what we wanted to talk about today is what are the obstacles, financial, economic, regulatory, political, to stepping up infrastructure spending in general. We're going to take as given that there's a need for more infrastructure spending. And just a few words about the backdrop. In 2015, the last year for which we have complete data, spending at all levels of government on structures, equipment, software, and R&D was about 3% of GDP gross. But net investment, that is minus deterioration, depreciation, was barely above zero and far below the historic ranges of 1% to 2% of GDP. Now, we know that the bulk of public investment in this country outside of defense is done at the state and local level. It's pretty volatile, but it's been on the decline since the early 2000s. It's fallen in most states as a share of GDP between 2000 and 2014 as the average age of infrastructure has been lengthening. We know that even though there are balanced budget rules in states that allow for them to borrow during recessions to build capital investments, state and local investments fell during the recession and hasn't really recovered. Now, it's not like you'd think if you read the American Society of Civil Engineers that we should be afraid to walk outside the building because the sidewalk would collapse. There are some signs of progress. The percentage of bridges classified by the Federal Highway Administration as inferior or structurally deficient has come down quite a bit and so forth. But there's still lots of structurally deficient bridges. Those of us who use subway systems in Washington, D.C. and in New York City understand the cost of deferred maintenance. And then there are the water pipes, the tragedy in Flint. The American Society of Engineers says there are 650 water main breaks in this country every day. 650. Now, at the Hutchins Center here, Brookings in particular, we kind of feel like sometimes the conversation about public investment makes it seem it's only the tangible stuff. And we think that public investment in human capital is incredibly important, and we've done some work on that. But today we're going to focus primarily on physical infrastructure. And with all the talk of private money that's supposedly so eager to get into the game, with all the concern about decaying infrastructure, with all the headlines, with all the angst about lousy productivity growth, with interest rates still relatively low, what's the rub? Why hasn't there been an uptick in state and local public investment? So we have a terrific panel here that's well qualified to discuss this. At the far end, Steve Wood, who's been a public finance banker for 3 decades and once upon a time was at the Illinois Department of Transportation Budget Office, but takes no responsibility for anything that happened after he left. Lois Scott, who is, I asked her, what do you do now? And she gave me a long list. I think it's suffice it to say that she seems to have found a life as a professional director of a wide variety of organizations, but we invited her in part because of her experience as the former CFO of the city of Chicago. Darlene Green is the elected comptroller of the city of St. Louis, the chief fiscal officer. I was somewhere between shocked and amazed to discover that you've had that job since 1995, which makes me question your sanity, but appreciate your commitment to public service. I want to note, because of one of our co-sponsors, that Darlene is a graduate of Washington University. And finally, Sarah Klein, who's now a fellow at the Bipartisan Policy Center and a consultant, but has in the past been on the staff of the Senate Banking Committee and has also at one point director of policy and government relations in the Washington Metropolitan Transit System. We also don't hold you responsible for any problems we had today. And so we're going to have a conversation. We've got about 45 minutes before lunch. And Steve, I'd like to start with you. It seems to me that there's just an extraordinary amount of bullshit about what private money is going to do for us. The rhetoric suggests that there's all this private money out there, private equity, Chinese firms, and they all just can't wait to spend it to make the infrastructure in America better. And paying it back seems to always be something, well, we'll talk about that later. So could you talk a little bit about the bright line between funding and financing, and how should we think about the role of private money here?
Sure. He hit it on the head, and the terms that we tend to use are funding and financing, and in common English, those terms tend to be used interchangeably. But and I guess it's important for a group like this to begin to establish a clarity of terminology, so that as we go forward, we can begin to talk about these things and understand what we're saying. What is emerging in our business, we'll call it inside baseball. Funding is the revenue for a project. Financing is the financial arrangements, such as bonding or some sort of equity investment or some sort of concession arrangement, where you're in effect time-shifting revenues that are going to be produced in the future to allow yourself to amass capital to build a facility now. And and it is a common truism that there's all this money out there, that investors love infrastructure investments. And it's kind of like David Letterman used to say, Germans love David Hasselhoff. And it trips off the tongue. And the real phrase is a longer phrase, and it's investors like infrastructure investment returns. That's what they like. And in fact, the last panel, there was a notion of and I'll explain that a little bit more, just to be sure it gets really nailed down in everybody's mind, the idea of enterprise bonds and an enterprise. So the phrase is investors like infrastructure enterprise revenue returns. So what does that mean? They need to be paid back. And it's bonds. We think about bonds. Nobody questions we're going to pay back bonds, and they're water bonds, sewer bonds, they're motor fuel tax bonds, tollway bonds, and it seems like a natural thing. And so it's like, well, no, equity is going to be different. You don't have to pay equity back. It's just going to go in. It just kind of sits there. But when we put our financial models together, we do our concession planning. We have lots of money going out of the box and out of the model into the equity providers' pockets. And so there's a rental for their financing up front, and that rental is basically comes out of the enterprise and the revenues. So I almost feel badly having to say these things, because it seems like, well, no, we already know this, and I imagine half the people in the room sort of like, why is he saying this? It's so basic. But in preparing for this conference, I had several conversations where this very confusion was very evident. One with an old standing, I'll call it an engineering feasibility consultant, and the conversation goes like this: $1 trillion program from the federal government. That's great. Listen, how great is that? The old method was take highways, 80% federal share and 20% state and local share, and so that would be $800 billion from the feds and $200 billion from the states. And now look at this great new idea. We're going to do $250 billion in tax credits. So the federal share has gone from 80 to 250, and the state share will say that stays the same, 20 to 25%. And then the private sector will incentivize all these people to come in and put all that money in. And in that little movement from that description, we've gone from 100% pay-as-you-go funding with federal grants paying $800 billion, 80%, to 100% borrowing. That the tax credits is essentially a borrowing program. The private finance is a borrowing program. The states are probably going to borrow for their share. Some of it might be pay-as-you-go. So that $1 trillion program just went from a funding program to a borrowing program. And so until you see the other side of that coin, which is to hear the proposer say, oh, and here's $80 billion a year in funding to pay the rentals for that $1 trillion, until you see the $80 billion, you don't have a program. There isn't a funding program. There isn't a viable program. There's nothing we can do with modeling. There's nothing we can do with the private sector to create an enterprise that's going to invest $2 trillion.
Thank you. So, Lois, you've had some experience with P3s in Chicago. From the issuer's point of view, from the city's point of view, what are we to make with this new fascination with public-private partnerships? Where is there potential and where is there harm? And touch your button on your mic. The one that has a little face with a voice coming out of it.
The face is not very clear, just in case you wonder.
No, I totally agree, right?
So if there's one takeaway from the conference on P3s, I think it's Steve's point, and that is that there is no amount of financing that makes up for lack of funding. No amount. It's like you get a credit card application 5 times a day in the mail. Doesn't mean you have any greater income to pay off those credit cards. So I think that is the most important takeaway. The second takeaway I would add is a point that even finance people often miss, and that is that the difference between a 6% borrowing cost and a 3% borrowing cost is not 3%. It's 42%. So if you have a project that you can finance at 3%, that's going to cost you about, over 30 years, about $5 million a year for every $100 million you borrow. If you have to borrow at 6%, that jumps up your annual cost to $7.25 million, or a 42% increase. So if you look at the cost of any capital project, any infrastructure project, the single greatest cost of the entire project is interest or financing costs. For a $100 million project over 30 years at 6%, you're going to pay $117 million in interest on a $100 million project. So it's more than the cost of the project. And we keep missing this point. As finance people, as in the municipal finance industry, as infrastructure specialists, we keep missing the point that anything we can do to drive down the borrowing cost is going to dramatically increase the amount of infrastructure we can get done. I'll give you a case study. In the city of Chicago, as CFO, I had the privilege of managing a lot of P3 projects. We had the street furniture project, we had underground parking garages, the Chicago Skyway, the Chicago parking meters, which was lots of fun to manage. We also had the Midway project, the Chicago Digital Network project, and we also had a project known as the Riverwalk. Riverwalk, if anybody's been to Chicago, is a 6-block area on the river that had been on the drawing boards for 50 years, literally 50 years. It had been out there. Yeah, this is something Chicago should do. It's a beautiful waterfront asset. We should develop it. Nobody could figure out how to develop it. The reason that project got done is because we redesigned what the project was. We rethought the project as a multimodal transportation project because it rests along a major local road, that Wacker Drive project. It had been completely rebuilt with support from the U.S. Department of Transportation. The waterways is a transportation element. We have tourism there. We have water taxis. We have people walking down there. We redesigned it as a transportation project. That then made it eligible for TIFIA financing. Why is TIFIA financing important? Because we borrowed at 3.3% interest. So instead of that $100 million project costing us $217 million in total spend, it now brought it down to a $153 million project. That is ginormous in terms of what you can actually do, huge. We then took a look at how do we create the revenue stream. Well, governments don't always think in terms of long-term revenue streams, but we had tourboat revenues that had been for decades and decades and decades in Chicago, licenses to operate tourboats along that riverfront. Instead of doing 3 to 5 year contracts, we extended those to 20-year contracts, which then make them financeable. So there was no fundamental change in what was going on, but we took advantage of the opportunities the federal government had provided to bring down that borrowing cost. So all of a sudden, we were able to invest opportunistically in infrastructure that was critically important to the city in terms of our cultural attractions, in terms of transportation, et cetera, but we used different tools. So I encourage, as we think about the role the federal government should play and how we get people jumpstart on infrastructure investing, of how do we drive down the cost of these projects, not concrete, not steel, how do we drive down the financing cost, which is the number one expense of any infrastructure project? How do we drive that down through programs like with TIFIA, WIFIA, RIF, which enable governments to borrow on a subordinated lien basis? Subordinated lien basis, that means you're leveraging big time against small public dollars. A 1 basis point over treasuries, long treasuries, which means today you could finance at 2.85%. That you can get a lot of infrastructure done. And you still have to have a revenue stream, which governments can think about and will think about, but you've got to give them a path and the tools to do so. So I can go through more in Q&A on P3s, what works and doesn't work.
Isn't it almost always cheaper to borrow in the government market than in the private market?
I think that depends on how you assess risk. If you assume it's a risk-free transaction, yes, it's always cheaper. But if you want to transfer risk to the public sector, to the private sector, then you have a completely different way of looking at it. So the private sector can take revenue risk, as we've seen them do repeatedly in all the projects that are failed P3s. It's because the private sector took revenue risk that the public sector was not prepared to. The highway development in Southern California, which is pointed to as a failure in the P3 world, is because the private sector took the risk of revenues, toll revenues, that did not materialize. And so the private sector might have gotten a higher rate of return because they were willing to take that risk. So it is not just about the absolute return, it's the risk-reward ratio.
I see. So, Darlene, I wonder if you could talk a little bit about what are the competing demands on a municipal budget? We here in Washington think everybody should spend all their money on education and infrastructure, and then we'd have higher productivity. But I know that there are both real priorities at the local level and political issues that can become obstacles to increasing government infrastructure spending.
Well, you're absolutely right. There's always a balance of priorities, whether they're political priorities or whether they're priorities for essential needs, to deliver to our citizens. In the city of St. Louis, where I'm the comptroller, the number one issue right now for us is crime, public safety. How do we keep our streets safe? And we could look at that as an obstacle to funding some of our infrastructure needs. But then at the same time, we got to look at, sometimes we have revenue streams dedicated to infrastructure and other capital needs. For example, we have a half-cent sales tax and other kinds of taxes strictly dedicated to funding capital needs. So when you think about $20 million a year coming in, you still have that bucket of monies dedicated to capital needs and infrastructure. And then you have to look at the priorities of how that's going to be spent. And it would be great if $20 million each year is available to be spent on your current infrastructure and capital needs, but then you got to remember that some of that, and in our case in St. Louis, the majority of those dollars are now being paying for debt service on those infrastructure needs that you had 20 years ago. So you got to look at, what's left over. Is there enough to even begin to think about funding new infrastructure needs and capital needs? For example, we have a train, local train, Metrolink, for public transportation, and so the current talk is about a new route. And so in the city, we are, talking about the north-south route that would connect the north side of our city to the south side of our city, which would go into the counties. Well, that would include the priorities of many people, political as well as communities, because you're talking about connecting communities throughout the city and all the way to the North County and the South County. And so you have the mayor and the county executive's political views to be considered in terms of, who's priority. So right now in the city, the voters voted to pass dollars to pay for that. So we're set, ready to go as soon as the county gets their act together. And then as you face the 2018 election, which the county executive has to get on the other side of course, he's going to be staunch about protecting the wants and needs of the county. We won't know where the route is going to be because there's a couple of routes that the county's talking about, west and routes as opposed, or east-west routes as opposed to the north-south route. So the determination of what the route will go is going to be years down the line, even though the city's monies are adding up as we speak, ready to be dedicated to that particular project.
Talk a little bit about what were the politics of getting that approved? Was it a referendum? Do you have dedicated revenues?
Believe it or not, it was a sports arena, part of the, I mean, how did I jump from that? But a lot of times you got a lot of competing needs. We had the idea of a soccer stadium being located in St. Louis with the competing needs of transportation and other kinds of capital needs. And so all that kind of got put on the ballot, Prop 1, Prop 2. Prop 1 says, okay, here's how it's all going to be paid for. Prop 2 says, well, if you pass all of this in Prop 1 and you get the taxes, then you'll also have the overlapping use tax that will pay for a stadium, which was Prop 2. So nobody wanted the stadium, but we wanted the money, so Prop 2 failed. And so that's how we ended up with the money for transportation that's yet to, line that's yet to come.
Okay. You might have to explain that to me again. That's before we get into the Rams, right?
Well, that's post-Rams. We're going forward. We're going to have this soccer stadium, according to what I'm hearing.
I see. So, Sarah, in a different universe, we'd have somebody for the Trump administration explaining the president's infrastructure policy. And I had some conversations with people in the administration, and one guy who actually understands this pretty well and who I respect said to me, I'd really like to do this, but I'm tired of being on panels where I have to explain to people that, well, we really don't have a plan that I can explain to you. So I'm not going to ask you to explain the Trump administration's plan, but I am interested in what you see as the political and economic and financial issues in getting some kind of big federal infrastructure package done, whether it's, whatever it is, Build America bonds to the Wilbur Ross's tax credits.
Well, that's a great question. I'm sure I'd like to know the answer to that as well. But I think that in terms of sort of what are some of the barriers at the federal level to getting an infrastructure package done, the major one that I see is not actually something that's talked about a lot, which is actually the disconnect that has emerged between what people see, the general public, people who actually experience transportation and infrastructure crises on a daily basis, what they see in their communities and what they think a federal infrastructure package will do. So let's go back in time a little bit to the 1950s. Federal infrastructure programs were building the interstate highway system. People saw those connections coming into being. Fast forward a little bit, we're in the 80s, we're moving out to the suburbs, roads are being built to connect people back to the jobs in the cities, to bring their, the homes and all that are then going to be accessible. There's a direct connection between what the federal government is doing and what people are experiencing in their communities. Now fast forward to today, we've got crumbling infrastructure that you alluded to. We've got the interstate highway system basically built out. We have 100-year-old subway systems in New York and Boston, Philadelphia that need investment. We have all sorts of different needs all around the country. If someone asks, what would a federal infrastructure package do? The answer is, it'll bring money to infrastructure. What is infrastructure? What is that going to come to my community? Is that going to go all to fixing the New York subway? Is it going to go all to building out new outer ring beltways in different places? What is that? People have lost the connection to federal infrastructure programs. In part, that's due to now we don't have earmarks anymore. When we had earmarks, someone could say, well, I don't know what that other $600 billion is doing, but this money is coming to my community. But more than just the earmark issue, we don't necessarily have a national vision or plan anymore for what our infrastructure program is intended to do. And I think that gives senators and representatives real angst about why would they vote for a package. Their constituents aren't calling them up and saying, we want billions of dollars for infrastructure. They're saying, I want this road fixed. I want this pothole fixed. And there's not necessarily that trust to that the federal government will be able to make that happen. With regard to the Trump plan, I'll just comment a little bit on that because we've had some comments about private capital and P3s. I think that actually there is a role for private capital and P3s, and it's not cheaper financing, and it's not funding. as has been explained. It is greater efficiency in the delivery of projects, and ultimately, for some projects, it's a cost reduction over time that's experienced because you've got a project where it's very complex and the public sector is able to shift risk over to the private sector. Perhaps the private sector has expertise or are able to bring in innovative technologies, et cetera, that the public sector may not have. In some cases, P3s can deliver great value both for the returns for the investors, private investors, and for the taxpayers, but not in all cases, and they need to be very carefully negotiated. And I think the mistake that the administration is making is that they're not necessarily seeing these subtleties. Even in countries that are making much greater use of P3s than we are here, there's still only 10, maybe 15% of infrastructure in those places that are using them extensively. P3s are not the only answer, and yet that when people are asked, what is the Trump plan? That seems to be the only answer that's being proposed, and I think that's a problem.
Why is it that what is the role of the infrastructure bank, which seems to draw so much attention, particularly from Democrats, some of whom I think talk the language of it's going to get all this private money in, but other of whom see it as a kind of National Institute of Health way of getting beyond the formula where Montana has to get a road because Southern California gets a road. What are the substantive issues with that, and is there some potential there, do you think?
So the beauty of there we go. So the beauty of an infrastructure bank is that it can be whatever anybody wants until anybody actually has to define it on paper. And some people have done that and introduced bills and such to define what they think it would be. I think one of the critical questions about an infrastructure bank is it funding or is it financing? If it's financing, great. So we'll have another financing tool to bring down the cost of capital, hopefully, and make that cheaper capital available for more projects. Whether they're P3s or not, I think we could benefit from additional access to the lower cost capital. But it's not funding, and I think a lot of people conflate the two, and they think, oh, a national infrastructure bank is actually going to address our needs because all this money will be flowing to infrastructure. Yes, but it is financing, it's cash flow, it's going to need to be paid back. So that's the first sort of issue that I think people need to recognize when conversation turns to a national infrastructure bank. The second issue is really sort of those decisions of, well, who's going to be making the decisions about what projects get funded? Is this essentially going to be taking all the politics out of infrastructure? That would be a tremendous feat. Probably would have some benefits, but I'm not quite sure how that would actually work. And those are some really difficult questions that need to be asked. Where should we be investing? How are we going to measure the performance of what gets done? How are we going to make decisions about how we're going to allocate our scarce capital, because we're never going to have enough to do everything. So a national infrastructure bank is a flashy idea, but there are some really serious questions about how it would get structured and what it would do.
So Steve, you made the good point that the money has to be paid back. So just from your perspective, how do you look at the politics that seem to get in the way of agreeing that if we're going to pay it back, it's going to be tolls or it's going to be taxes or some other user fees? That seems to have become a stumbling block.
Well, yeah, absolutely. And actually, there's kind of a couple of cross currents of issues. One is the federal role versus state and local roles. And so a lot of the discussion that surrounds the Trump administration and the federal role may actually not apply at the state level. And in fact, when you look at the states, I think in the last 3 years, 12 states have increased gas taxes. And as the mayor of Atlanta last night pointed out, that localities can and do actually do things. I know that certain counties have actually imposed, their own motor fuel taxes and taken the bull by the horns to invest in revenues that will be dedicated to infrastructure. But I think, though, the general feeling is, the general malaise is the fact that the political rhetoric and the political dialogue is actually following, we'll call it the federal model, the federal rhetoric, the federal partisanship. On the one hand, the paradigm, we'll call it from the Republican side, is government's too big. We are taking too much money out of the wallets of our people. If we could leave it in the people's wallets and they would apply it properly, then then we wouldn't. Then the economy would grow and we'd be better off. And of course, on the Democratic side, it's, well, if we could only get all those rich people to give up their money and give it to needy people, then we'd be better off that way. And what's lost in this is that infrastructure is scored the same way of other programs. So there's not a sense, if you spend $1 billion on a bridge, Tappan Zee Bridge, for example, that bridge is going to be there for 30 years. That is an asset that endures for all of society for 30 years. If you spend $1 billion on another kind of spending program, what happens there is it's gone in a year. So the rhetoric and the dialogue actually doesn't adequately capture the nature of physical infrastructure as a political investment. That's I think that's the main thing. And
Darlene, can you talk a little bit about, so do you perceive that the voters in a city like St. Louis are willing to pay, whether it's tolls or taxes, to get better infrastructure? Or is that a case that's just really hard to make unless you have a soccer stadium attached to it?
And you ask it, that's a good question to ask because there are competing needs throughout the metropolitan region. We got like 1.2 million people in the metropolitan area, which includes the city and the county. And I say all that to say that in the city itself, city proper, there's 317,000 people. And so our votes in the city have always been consistent to take care of the needs, the roads, the bridges, or whatever the needs are. So we are a city that's going to vote for a tax. We're going to pass a tax if it's about infrastructure or the needs of that community. But it's quite different in the surrounding counties. All those other cities, the bedroom communities, so to speak, have, education is a high priority in some and other kinds of needs in others. So when you put that all together, when you talk about how the voter's going to respond to an infrastructure need, the play is what is it that you've done for me lately kind of thing. And the last time, when the Rams left, we had this whole issue about, well, the next time that the city's asked to fund a stadium, then we'll have a vote. Well, then the courts threw that out. So then the people in the city felt like they were, disregarded. And so you go back. This time you got the soccer stadium, as kind of a thing to think about, but it's more for county as opposed to city. So we don't, in the city, necessarily want the stadium because we know what happened with, the Rams, they left. So we're going to vote to pass the dollars to fix the needs, the essential services. Even though taxes are regressive in the city of St. Louis, we just had that historical trend of passing those kinds of taxes. It's totally different in the county, totally different.
And what role does the state government play in these kind of things?
Well, we would like for them to play a much larger role in the city, but they do play a role in taking care of some of our major thoroughfares, some of our larger streets. Like, for example, the Kings Highway is similar to like in Kansas City's Paseo, and I think in LA you have like a Highland, those big streets like that. Well, the state transportation department takes care of that. And so, and there's several of those kinds of streets and some of the bridges and that kind of thing. And then we have a huge amount of private investment for like some of our city jewels like the Forest Park, for example. We have some monies that taxes, pay for, but then we have a huge community of philanthropists that put together those dollars to take care of that particular park. So,
Lois, does in addition to the financing, there's always these questions about regulation. And have we made it so expensive to do physical infrastructure? I've heard Rahm Emanuel talk about this. I can't remember the number of years, but 10 years to build a project, 7 years to do the permits, and 3 years to build the project. Is there something there that we could do better to make it easier to do public infrastructure?
I think there's no question that we can do better on the regulatory framework and how quickly we can work through things. There's no question about that. But, I always go back to the general paradigm I have about working in the public sector versus the private sector. In the private sector, and with a lot of the finance people in this room, we believe that the right answer is always the best finance answer. And in the public sector, you have to consider other agendas, and they are all valid. And the flaw of finance people often is that we think the only agenda should be this is the lowest cost or this is the financial answer, therefore that's correct. And that's really, nothing could be further from the truth. It's the difference between playing checkers in the private sector and chess in the public sector. But let me comment a little bit about deconstructing P3s, because I think we often miss, we deconstruct them as an industry into DBFOMs, design, build, finance, operate, maintain. I would deconstruct them totally differently. I think that the real deconstruction of a P3 is FOIA, that's my government speak. Who's doing the financing? Who's operating the asset? Who's investing in the long term? And who's accountable? And if you deconstruct them that way, I think that they change their complexion completely. Because I think what the P3 model does extremely well, as Sarah points out, is actually getting things done faster, but also we codify the operating standards. Governments are not very good about saying to their public, these are the operating standards we're going to be held accountable for. You want your garbage picked up on Tuesday by 10, it's going to be picked up Tuesday by 10. Public sector doesn't operate that way. But when we introduce the P3 private sector world, we do. We say the Chicago Skyway must be repainted every 3 years. We say if there's a broken parking meter or the parking meter's payment system is down, it must be fixed within 24 hours. Actually, it's being done in about 15 minutes now. But we codify the operating standards, which is a level of accountability to our public that the public is desperately missing right now. And that is the discipline and the value introducing that private sector party in there, not just for getting the project built more quickly, but creating, codifying operating standards and holding somebody's feet to the fire, and then creating an accountability mechanism in partnership with the public sector.
Can I comment just briefly on the regulatory question that you asked, and tying it actually into the accountability that you just raised? I think it's sort of easy to point to, there's a lot of regulations and they add a lot of time, but there are examples now of projects that are moving through quite quickly, and the things that are leading to those projects moving forward quickly are transparency, public accountability. So the previous administration started, and the new administration has continued, a permitting dashboard for major infrastructure projects, which shows all the permits that they need, who's responsible for issuing those permits, and when they're supposed to do that on schedule. And from what I've been hearing, that has actually been accelerating these projects significantly without having to change any of the underlying regulations. So there is stuff that can be done even on that level.
Sarah, one of the things that, if you get 4 economists up here, they'll say it's obvious we ought to have a lot of user fees. We ought to have tolls on highways. We ought to have private airports that are paid for by the users of airports. We ought to have more. And then the people on the left say, I don't know, it makes me a little uncomfortable. Lexus lanes, the only people who are going to be able to get to work on time are people who can afford to pay the $3.75 to go 2 miles. Is there a limit to how we can use user fees that, because of the distributional consequences, or is that just a guilty liberal conscience speaking?
I think that has to go back to the public sector chess game that Lois was referring to. The market-oriented folks will say, it's a little more checkers. User fees are going to help determine the right pricing. They're going to align incentives so that people use what they need and don't use what they don't, and it's not wasted. And there is some validity to that. But in terms of policy making, it is more of a chess game, because I do think you have to think about what are the implications going to be for different types of user fees. And it's not just folks on the left, although definitely they tend to be concerned about the impacts on particularly folks who are low income, et cetera. It also affects rural and urban people differently. And the politics there are not left-right necessarily, but more urban-rural. And so there are different user fees impact different groups of people differently, and that raises a host of political questions. And so, like with everything else, I think the question has to be one of balance. A lot of the debate tends to be, it all has to be public funding, it all has to be user fee. We need to think about using a suite of solutions and the impacts of that, as opposed to it's all or nothing, one way or the other.
So let me ask you one lightning round here before we turn to the audience for a few minutes. If you look across the levels of government, state, local, and federal, and you accept my premise at the beginning that we have less public investment in infrastructure than we would like, what is one public policy that would remove an obstacle or accelerate public spending and infrastructure? Steve, why don't you start? If you could change one public policy at any level of government that would lead to increasing infrastructure spending, public infrastructure spending, what would it be? Okay, you can pass. Sarah, you can start.
Okay.
I'm going to come back to you, Steve, so you better keep thinking. And when you're last, you get fewer choices.
That's right. I'll start with the first one that comes to mind, and then the insightful, innovative stuff can come from the rest of it. So the first thing that I would do is actually index our fuel taxes at the federal level, because that was a mistake in the 90s and previous times, because failing to index these things so that they continue their purchasing power as inflation rises, it means that you have to keep coming back and reauthorizing taxes. And who wants to do that? Nobody wants to do that. If they're indexing for inflation, you're at least keeping up your purchasing power without having to go back and vote on it every couple of years. Now, some people may say, well, then you're losing transparency and accountability. But I think we can build those things in on the program side. How are you using the funds and what are we getting for it? But having the certainty of funding will enable more private investors to come in. They want to see that funding certainty. It'll enable more state and local leaders to do more investments.
Darlene?
I don't have a change, but I have one that I don't want to see, and that is the federal proposal that would eliminate or limit the tax-exempt status of muni bonds. We need to not do that because, of course, we already know that the muni bonds is the lowest cost of borrowing, and that's what we want to continue to use as a tool to build infrastructure. So please, let's do something about that federal proposal to just get it off the table.
I thought you were going to say that the city of St. Louis should annex all the counties around it.
We at least want the airport.
Lois?
I guess the first thing I would say, no surprise here, is I would take the TIFIA example, replicate it across other types of infrastructure, and dramatically reduce the barriers to using TIFIA. Right now, it's a $50 million minimum project. Well, if you're the city of Peoria, a $50 million project is pretty unusual. If you're the city of Chicago, we do it every day. But I would dramatically bring that down, apply it to much smaller communities, and expand it across schools, WIFIA, rail, and a whole host of infrastructure. But the one thing I would say to Sarah, if I can go back and forth here from the podium, I would not index the motor fuel tax. I would completely change the way we tax, because with the rise of electric vehicles, and that is going much faster, just in the newspaper today, it was the New York Times talking about it, we have to change how we tax transportation, because with electric vehicles, we have no gas tax coming, and that is going to change. So Oregon is the only place that's doing vehicle miles traveled. I think the federal government should adopt a vehicle miles traveled approach.
Okay, Steve, did you come up with anything?
Yeah, what they said. Well, it's not so much a change, but it's an actual, maybe it is a change, that the federal government needs to have a vision and a role. And part of that is that, so much of infrastructure is local. It is the nuts and bolts right in front of us. But at some level, there's a need for, let's make America great again, and the statesmanship of recognizing that what infrastructure is. We're United States. We're a series of great cities connected by terrific transportation systems with great water resources, great environmental sewer protections, and at some level, there is a federal role. And it should be crafted to facilitate efficiency across and above all of those borders. We have 50,000 water systems in our country. One of the ways that the private sector helps, and one of the things you see, you go to business school, what is it that makes a corporation a good thing? Scale. Why do we have 50,000 water systems? What if we only had 1,000? Imagine 1,000 different water systems. Imagine, only instead of 200 in each state, only 10 in each state. There could be a number of things that the federal government could do to allow and foster, essentially, a rethinking of the way our jurisdictions collaborate and work together to get scale.
Okay, I'm going to take 3 or 4 questions, and we'll get the panel to respond to them. So if you have a question, Bill Glasgow over here and Mike Belsky over here. Mike, could you raise your hand again so the mic can find you?
Well,
Bill?
It's two very short comments. One is to take off on the electric vehicle comment. We may be talking about a mass infrastructure program just as the entire nature of transportation is changing. Transportation as a service is going to have profound implications for parking garages, all kinds of municipal revenues, and I think we have to think very carefully about that. The other comment is the municipal bond market is capable of raising $500 billion a year, and there's revenue there to support it. Unfortunately, the municipal bond market has been in liquidation mode. Tom Kozlik would have the numbers. It's been in liquidation mode for 5 years now. So we're really making a statement that we don't want to spend money on transportation, on not on transportation, but on school buildings, roads, bridges, water plants, what have you. It's a national statement that's being made, and stuff is being replaced only when it absolutely has to.
Thank you. Mike?
Well, this is kind of the flip side of what Darlene was saying about not taking away tax exemption, but I was wondering the panel's thoughts on, there have been talk about expanding it to private activity bonds and also things like making bank qualification at a higher level, and even P3s being tax exempt. So I just wanted your thoughts on that.
Good idea.
Dan? Wait. I'm going to take one more question here.
Okay.
So if you think about the package of services that count as kind of the infrastructure basket, you can think of roads, you can think of access to an airport, maybe a park or two, a library. What is the status? How do people conceptualize access to the internet in terms of the basket of the infrastructure basket that a household has some right to expect?
Okay, those are all good questions. Let me start with the second one, which is what is stopping state and local governments from borrowing more money to build infrastructure that the public seems to want?
Part of it's rating agencies. Rating agencies do not rate the quality of infrastructure. It's not even discussed. At the City of Chicago, we had 45 separate ratings. The quality of infrastructure was rarely discussed, except when it was related to an enterprise fund and it was the average asset age. But if you're talking about the state of Illinois, City of Chicago, City of Seattle, the question about the quality of our roads or bridges or whatever is not even on the list of questions asked. What is asked is what's your leverage, how much debt are you adding, what's your debt services percentage of budget. So I think it is some of those third-party actors that are influencing behaviors.
Well, I agree with your expansion idea for exemption when it comes to P3s and the private activity bonds, because that would put more money into funding for the roads and bridges and infrastructure. So I would say yes, expand it.
And if I can comment on the inability to raise money, essentially, I think it goes back to what I was saying at the beginning about how people don't see the need to, they don't see the value in giving government more money to do this stuff. They don't necessarily think that it all needs to be paid for. I heard it was on a panel the other week where somebody said, we've taken a generation off from paying for infrastructure. We paid for it in the 50s, we've paid for it through our water bills, but if you've ever seen a place try to raise their water rates, you see that people do not make the connection between what they're paying and the service that they're getting. And so I really think we need to reestablish that connection. If you want clean, safe water, we need to pay for it. If you want roads that work and transit systems that work, we need to pay more for it.
Right. I mean, I think the erosion of trust in government and other institutions in our society is paying these horrible dividends that the people really don't trust the government will do what they say, and that's the thing. I think, Darlene, it's nice to say that we should make everything tax exempt and cheaper, but there's a price on that. And so that means the federal government is going to have to raise taxes or cut spending somewhere else to pay for it. It's not free money. I can certainly understand why, as the comptroller of St. Louis, you'd like more tax-exempt bonds, but when you look at what the federal deficit is, you can't ignore that. Does anybody want to comment? There were two questions, really, which I think are good on technology. One is, Bill Glasgow's pointing out that when we think narrowly about roads, the world might be really different in a world of where everybody has access to an electric Lyft or Uber. And Dan asked about how do we think about infrastructure and the national broadband network?
I'll start about broadband. I think that it is very much a part of the federal conversation about infrastructure, particularly in underserved areas where it doesn't necessarily make economic sense for the private market players to provide service in those areas. There is a growing recognition in Congress and in the administration, I think, as well, that some public support is going to be needed there to make sure that broadband is extended to those places. There's an effort going on in Kentucky right now through a P3, actually, to build out the access broadband throughout the state. Their state of Maine is trying to work on that as well. So I think there is a growing recognition that broadband is starting to become core infrastructure in terms of keeping the economy moving and giving people access to opportunity, just the way a road was 50 years ago.
Well, the mark of a good panel is you don't want it to end, but we're 5 minutes over. So I'm going to call this panel to an end and call our conference to an end. I want to thank my colleagues at WashU, Brandeis, and the University of Chicago. The reason you didn't have to pay to come here and the reason you had free food and wine last night was that the four institutions together have pooled their resources to make this possible. It's an experiment for us in trying to get different groups of people who don't often speak to each other, from universities to comptrollers to rating agencies to regulators to academics. And I'm pretty pleased with how it's gone. I hope you are too. And to that end, we're going to send around a Survey Monkey to everybody who registered, and really appreciate, even if you don't have time to do all the questions, just to give us some guidance about, A, what did you think worked well? And B, what would you like to see us do in the future? We're not wedded to any particular format. But if you have an idea about a topic we ought to explore something, it's really helpful to give us a name of somebody who you might think contact to work on it. We are committed to continuing this in the future, and we'd like to make it better. All the papers are on the website. Videos from the last night's session and a couple of sessions will be posted eventually. And then we had a photographer here yesterday, and we're going to put a lot of those pictures on the Brookings Flickr page, so you can go and see if they caught you doing something embarrassing, like talking on your phone when you should have been listening. When you leave the room, if there's papers at your feet, if you could put them in the garbage can at the back, we'd appreciate it. And for anybody who's interested in hanging around, one of the feedbacks we got in the past was that in the previous conference, we didn't allow enough time for networking and schmoozing, which is why we built in coffee breaks and cocktail hour last night. So in the room in that direction, the Summers room, the guard can direct you. We have a buffet lunch, no program, but anybody who wants to eat and keep talking, you're welcome to do that. And I want to finally thank Lilia Cherchari and our research assistants, Mike Ing, Sarah Belt, and Vivian Lee, and some of the other staff from our conference services. As you all know, these things, although you like to think they happen automatically, it turns out they don't. And so we're proud of the infrastructure we have here at Brookings, but we're aware that it takes people to make the infrastructure work. So with that, thank you all, and thank the panel.